financial markets remain fragile, with an increased focus on the next steps to be taken by President Trump on trade policy. Looking back at the performance of G10 currencies versus the dollar in June, we can see the pro-cyclical currencies, the Australian and New Zealand dollars, suffered most during the month, given the growth uncertainties. The 10% gain in NYMEX crude oil prices in June helps explain the Norwegian krona being the best performing currency. But perhaps the most remarkable performance in June was the euro. The euro was basically unchanged, despite the broad strength of the dollar, despite the ECB's aggressive forward guidance that policy rates would remain unchanged until beyond the summer of 2019, and despite increased political uncertainty in Germany. That broad dollar strength during June was certainly in part due to the big FX story of the month, the largest jump in dollar CNY since at least 1994. That move helped lift the dollar more generally in the Asian region, and in part explains the underperformance of the Japanese yen in June, despite global equity market declines fueling increased risk aversion. Of course, the escalation of trade conflict concerns between the US and China amid signs of weaker growth in China explains the surge in dollar CNY. Hence, why the next policy step by the Trump administration will be crucial for market sentiment. The next step may well be an announcement of an introduction of auto import tariffs globally by President Trump, which would prompt an immediate deterioration in investor sentiment. As can be seen here, the numbers involved in US imports of autos is nearly 200 billion in terms of new cars. And then when adding auto parts, the figure becomes 335 billion, according to Commerce Department data. In contrast, steel and aluminium imports totaled just $45 billion. When you assume like-for-like retaliation action on the US auto import tariffs, the overall trade impact escalates quickly. Furthermore, this action, as you can see, would damage Mexico and Canada the most, and that would have immediate implications on sentiment in relation to the NAFTA trading deal. Speculation of a collapse in NAFTA would result in the potential trade impact moving to the trillions of dollars rather than the hundreds of billions. Also, Japan and Germany would be impacted, two of the United States' major trading partners, which would obviously have negative implications for Germany in particular, given Germany is the largest auto exporter in the world. In fact, this is already evident in financial markets. This chart looks at the performance of the major equity indices since the announcement in the United States that they were launching import tariff investigations. The German DAX is the worst performing equity market over that period, down just over 5%, in contrast to a much more modest drop of just 0.5% for the S&P 500. The TopX and the FTSE 100 have also declined. And then on top of that, if you go more specifically, the DAX Auto Index has dropped over 16% over the same period of time. But now, how might the euro trade in such circumstances of an escalation in trade conflicts that raises risk aversion in the financial markets? To answer that question, we looked back at the equity market performance since Trump's inauguration in January 2017. We managed to pick out 8 separate episodes in which the equity markets underperformed. As you can see, the underperformance in 2018 is becoming much more significant and more frequent. But how might the euro and other FX rates perform in these circumstances? Well, it's no surprise that in all of these episodes, the Swiss franc and the Japanese yen are consistently the best performing currencies versus the US dollar on a G10 basis. But in addition, the euro performs well. And of these 8 episodes, the euro was a top 3 G10 performer versus the US dollar in 6 of those 8 occasions. On one other occasion, it was the 4th best performer. So why is this? Well, like all safe haven currencies, a large, substantial external surplus is a crucial characteristic, and the Eurozone has this in abundance. So this shows the current account for the Eurozone in GDP terms versus the current account balance in the United States. For the euro, in GDP terms, it's approaching 4% of GDP. In value terms, over 400 billion euro, the largest in the world. Currently, the differential between the Eurozone surplus and the US deficit in GDP terms is the largest on record. And that is an important supportive feature for the euro in risk-off, safe haven type FX trading. So, taking this to our forecasts, as you can see in the blue dotted line, our forecasts continue to show the DXY declining. Now, most of that decline is now taking place in 2019. We have DXY broadly stable in the second half of this year, but we're still expecting overall about a 7% drop in the dollar. And that's partly down to the euro's safe haven characteristics. And the performance in June is certainly suggestive that the downside for the euro from current levels is relatively limited.